I can understand market players. They love to be long. It's been tough. It's been a tough year since January. And any morsel of good news they kind of embrace, and maybe the market gets ahead of itself. I don't know. Is the 10-year like that? What's it doing at 3.5%? And is that telling the Fed maybe your job is nearly done, or is it just likely to go back up to 4.25%?
The only way I can justify the 3.5% Treasury yield is that the market assumes that the Fed is going to do what's necessary to get inflation down to, a little over 2%. But given the very strong wage numbers that we saw in November, it's clearly the Fed's going to have to do more with the short end of the curve in order to achieve that target. It's probably going to have to induce a recession given the resilience of the labor market. And if that's true, it's hard to explain why the stock market is where it is. So I look at these two markets, the stock market and the bond market, and I say one of them's got to be wrong.
Right. What if there's a lot of different parts of the economy that aren't based on wages? What if we could get different parts of the economy cooler, or at least, commodity prices moderate, housing, moderates? Then the wage gains would be, if they were above inflation, we'd like them, wouldn't we? And productivity could increase, and wage growth could be back to being a good thing instead of a bad thing, Greg. That can't happen? Am I too Pollyannish?
Well, the market actually thinks that we will have inflation, headline inflation, back to between 2 and 3% in the coming year, if you look at the swaps markets and the TIPS markets. But that's primarily because you see a lot of mechanical things going on in the indexes, especially with rent, which is rolling over. Over the long term, you cannot have inflation at 2% if wages are not consistent with 2%, because, wages are 50 to 60% of the cost base of our economy. Moreover, where employers and employees agree on where to set wages tells you a lot about where they think productivity and pricing power are going to be. And what a 5% annual wage rate, or 6% in just the last 3 months, is telling us is that employers and employees think that they can justify wage increases of that area based on pricing power in the 3.5 to 4% range. Long way of saying, Joe, that I don't think that even if we get a low print on inflation a year from now, it's not going to stay there unless the wage numbers start to come down. And I think that's the way the Fed thinks about it.
I almost wish the 70s or 80s had never happened, Roger, because, that kind of got us in the mindset that it can happen again. And I think maybe it's not as similar to that this time around as most people believe. And the mistakes were so glaring back then and so long lasting. And even people that weren't alive know about the Fed's miscues back in the 70s and 80s. So I just hope it doesn't cause us to chase a phantom menace this time. But you don't think so?
I don't think it's a phantom menace. I mean, the numbers have clearly shown that inflation is running higher than the Fed's desired target. Frankly, the inflation numbers also are clearly having an impact on the welfare of low and moderate income people. And so this is not a phantom menace. This is a real menace. Having said that, this inflation is quite different from that of the 1970s and 1980s. And I think what the Fed is attempting to do is to make sure that it stays different, i.e. that they avoid having inflation expectations get baked in at a higher number. To date, inflation expectations have not picked up. But as Greg was saying correctly, the wage numbers are running very hot. We should also observe that the number of job openings, while coming down, is still roughly 2 to 3 times what the norm has been. And so I think the Fed clearly thinks it has its work to do. And as said, they're prepared to impose pain, which I interpret to mean hopefully a short and shallow recession if that's necessary.